In the world of personal finance, two distinct mindsets dominate the pursuit of wealth: building it slowly over time through discipline and sound strategy, or attempting to get rich quickly through shortcuts, risky investments, or speculative ventures. While the allure of fast money often grabs attention through viral schemes, flashy social media influencers, or stories of overnight success, true wealth, in most cases, is built through patience, compounding, and consistency. Understanding the major differences between these two approaches is crucial for anyone serious about long-term financial security. Below are the top 10 differences that separate those who build lasting wealth slowly from those chasing the often elusive goal of quick riches. 1. Mindset. Long-term thinking versus short-term gratification. The biggest psychological difference between building wealth slowly and chasing fast riches is mindset. Those committed to slow wealth understand that financial success is a marathon, not a sprint. They embrace delayed gratification, compounding interest, and the power of time. In contrast, those trying to get rich quick often exhibit impatience, a desire for instant results, and susceptibility to hype. They may ignore the learning process or long-term value creation in favor of short bursts of profit, often driven by emotion rather than logic. The slow builder asks, "What will this be worth in 10 years?" while the fast chaser asks, "How fast can I double my money?" 2. Strategy. Proven principles versus speculative tactics. Building wealth slowly relies on tested strategies like consistent saving, diversified investing, real estate appreciation, business growth, and disciplined budgeting. These methods have withstood economic downturns and market volatility. On the other hand, trying to get rich quick often involves unproven or speculative tactics: crypto hype, meme stocks, multi-level marketing, high-risk day trading, or in regulated ventures. These approaches may yield short-term gains, but they carry a much higher risk of failure. The slow route builds financial foundations that last, while the fast track often overlooks the basics in pursuit of a windfall. 3. Risk tolerance. Controlled exposure versus high-stakes gambling. Wealth builders who choose the slow route have a healthy relationship with risk. They take calculated risks, manage downside, and diversify to protect their capital. Their aim is to grow steadily and preserve wealth. Those in the get-rich-quick camp often embrace high-stakes gambles, betting large sums on risky investments in hopes of exponential returns. These all-or-nothing approaches frequently result in complete loss, leading to financial ruin or endless cycles of recovery. Controlled risk is the key to long-term wealth, while uncontrolled risk is often the downfall of quick wealth seekers. 4. Financial tools. Retirement accounts versus trendy platforms. Slow wealth builders often take full advantage of financial tools like 401ks, IRAs, index funds, real estate investments, and compounding savings vehicles. These tools are designed for stable, long-term growth. In contrast, quick money chasers tend to gravitate toward trending platforms such as cryptocurrency exchanges, options trading apps, and social media-driven stock picks. They often overlook tax efficiency and asset protection in pursuit of rapid profits. This short-sightedness can cost them significantly in taxes, fees, and losses, something disciplined investors work hard to avoid. 5. Education. Continuous learning versus FOMO decisions. Those who build wealth slowly typically invest in their financial education. They read books, follow economic trends, understand market cycles, and seek mentorship. Their decisions are rooted in knowledge and long-term planning. Get-rich-quick seekers, on the other hand, often act based on FOMO, fear of missing out, peer pressure, or hearsay. They may jump into investments without proper research or fall for scams because they lack the foundational knowledge to evaluate risk. One group learns to build, the other rushes to win. 6. Sustainability. Durable systems versus one-time wins. Wealth built slowly is usually supported by sustainable systems: regular income, budgeting, emergency funds, and recurring investments. These systems create a safety net and a roadmap for growth. Quick money tactics may work once or twice, but they're rarely repeatable or scalable. If someone makes a lot of money fast through a viral NFT or stock trade, they often struggle to replicate the success or preserve the profits. Sustainability requires structure, and long-term wealth thrives on predictability, not spontaneity. 7. Emotional stability. Patience versus panic. Slow wealth builders are emotionally grounded. They don't panic during market downturns, nor do they get overly euphoric during bull runs. Their emotional stability comes from experience, diversified assets, and realistic expectations. In contrast, fast money seekers often ride emotional roller coasters, high when things go well, devastated when they don't. This leads to impulsive decision-making and frequent financial missteps. True wealth building requires emotional discipline just as much as financial savvy. 8. Accountability. Self-responsibility versus blame game. People who build wealth over time tend to take personal responsibility for their finances. They track their spending, learn from mistakes, and make adjustments as needed. They don't expect overnight miracles, nor do they blame the system when things don't go their way. In contrast, those who chase quick riches often look for external sources to blame: bad advice, market manipulation, or unfair conditions when their plans fail. Accountability is the foundation of financial growth. Without it, sustainable wealth is impossible. 9. Lifestyle. Modest upgrades versus lifestyle inflation. Slow wealth builders often live below their means, even as their net worth increases. They prioritize investing over spending and view luxury as a reward for long-term discipline. Fast money chasers, especially when they do get a windfall, often succumb to lifestyle inflation, upgrading their cars, homes, and spending habits prematurely. This behavior can destroy their newfound wealth, leaving them back at square one. Living modestly and investing consistently is the proven formula for enduring prosperity. 10. Legacy. Multi-generational impact versus short-term show. Finally, those who build wealth slowly often leave behind more than just money. They leave a legacy. Their consistent efforts in saving, investing, and educating their family about financial literacy result in wealth that benefits future generations. On the other hand, those who try to get rich quick may not create lasting value. Even if they succeed temporarily, their wealth often evaporates due to poor planning, overspending, or lack of financial education. The goal of slow wealth is longevity. The goal of fast riches is often visibility. The difference between building wealth slowly and trying to get rich quick is more than a matter of timing. It's a difference in mindset, values, strategy, and outcomes. While fast money can be exciting and even profitable in rare cases, it rarely builds the kind of security, stability, and legacy that slow, steady effort can. The path to real wealth requires patience, knowledge, consistency, and emotional intelligence. It's not flashy, and it doesn't always look impressive in the short term, but over time, it yields far more dependable results. By recognizing these key differences, individuals can choose a financial path that aligns with long-term freedom rather than short-lived fortune. In the end, slow and steady not only wins the race, it keeps the prize.